the man behind the most successful recession indicator, is questioning it. Well, I have a question for you. Is the U.S. going into recession in 2023, or will the Fed orchestrate a soft landing? This is Andrew Stotz of the Become a Better Investor community. Let's get started. Remember, this information is for educational purposes only. This is not investment advice or a recommendation. I'd like you to meet Cam Harvey. Cam is a pretty impressive guy. He's a professor of finance at Duke. He's a research associate of the National Bureau of Economic Research. He served as president of the American Finance Association in 2016. He's been a visiting scholar at the Board of Governors of the Fed, and he's a fellow of the American Finance Association. And what's significant about Cam is that he wrote in 1986 this dissertation called Recovering Expectations of Consumption Growth from an Equilibrium Model of the Term Structure of Interest Rates. Well, there's an academic title for you, but what his one sentence at the conclusion of that says, the results show that the yield spread had some ability to predict future consumption growth both within sample and out of sample. The yield spread meaning basically when short-term rates go above long-term rates, then we're headed for a recession in about 6 months. Now, Cam is also a Joycean scholar. There's a picture of James Joyce, the author. I invited Cam onto my podcast, and at least he didn't refuse for such a famous guy. But the reply he sent me shows that he is a teacher at heart. James Joyce wrote the book Ulysses, and here's Cam's response. The main thing to look at, he says, in his P.S., I'm an amateur Joycean scholar. You need to fix your homepage. In fact, I had misquoted James Joyce by saying that he said that errors are portals of discovery. In fact, it was a character in the book Ulysses that he wrote that said that. So I fixed that and have moved another great quote onto that site. But let's now look at the tool that Cam used. Now, this is the 10-year Treasury bond minus the 3-month U.S. Treasury bond. And whenever it goes below the line, it means that the short-term rate, the 3-month rate, is higher than the long-term rate. And this has successfully predicted pretty much every recession since 1968. The yield curve has now inverted for the 9th time. And we can see that's actually one of the steepest inversions we've ever had, and it's persisting for right now. So did the man who discovered the most successful recession indicator abandon it? Well, what I found interesting in this recent LinkedIn post that Cam did, he outlined why his yield curve inversion theory may no longer work. Okay, that's interesting. While it has had a perfect record of predicting recessions, he concludes that we may not get a recession in 2023. So what are some of the arguments? Well, he argues that the labor market is strong compared to the past recessions, and we can see the employment rate is super high right now, so everybody's got a job. We can see nominal wage growth grew when money was put into people's banks accounts. That's starting to come down. The blue line's starting to come down. But overall, the employment situation right now is pretty strong. And unfilled jobs are still high, and skilled workers losing their jobs are going to get new jobs faster. And this is unlike the 2008 global financial crisis and the 2020 pandemic recession, where workers had no job opportunities. So losing a job is not going to be as critical because there's plenty of jobs available. Another one is consumers have less debt and are better prepared to withstand the rise in interest rates. Now, this chart shows the cumulative excess savings by U.S. households. And where did that excess savings come from? Well, you can see in first quarter of 2020, excess savings were basically zero. There was no excess savings. And then in 2020, in second quarter and onward, there was more and more. Where did this money come from? This money came from the government injecting money into either companies, into banks, and most importantly, it ended up into the deposit accounts of consumers or individuals. So consumers are actually quite strong because of the injections there. Now, the financial sector is also strong compared to 2008. I didn't have time to update this further, but I think it's pretty close to being updated. That is cash and securities in the balance sheet of the banks, reducing the risk of financial sector crisis that would exacerbate an economic crisis. It's incredible. In 2020, the Fed basically pumped a huge amount of money into the banks. And instead of the banks lending it, they held it as cash. So cash as a percent of assets is way above 10%. And here we can see almost $9 trillion there. Banks didn't lend, and therefore they're sitting in a pretty good position. So I think the point of this one is that there's not going to be a financial crisis. There may be a recession, but the banks are not going to be suffering. Now, Harvey continues that the reactions of economic agents could lead to lower growth. And if the economy survives that period, a soft landing is possible. So no recession. Maybe the widespread knowledge of the success of the yield curve has caused people to adjust ahead of time, which will lessen the impact. That's the self-correcting or self-fulfilling prophecy aspect of any idea or strategy that's put out in the markets. Is if it's true and correct, people will follow it. But not everybody is buying Harvey's reasons for banning his measures. So here's Leo Kolivakis, who said, I respectfully disagree. And let's look at some of the arguments made in the comment sections about why his inverted yield curve signal is working just fine. First counter argument is the labor force participation rate has been falling. Yeah, unemployment rate's high. That's just because many people have left the labor force. So it may appear that things are good, but in fact, it's not. In fact, labor participation rate has averaged 63%, but it reached an all-time high of 67% in 2000. So that's one counter argument. Another one is consumer debt is at an all-time high. Now here you can see consumer debt service as a percent of disposable income. I would say it's rising, but it's not at an all-time high as the counter argument went. Most relevantly, consumer debt service payments as a percent of disposable income are highest in over 13 years and still rising. Okay, if we go back for a decade, but hey, if you go back and look at 2020 as an example, we're far away from that bubble that happened, or the dot-com bubble. This is an interesting one because now we're seeing that consumer debt, credit card debt, is almost at $1 trillion and rising very fast. So I think you can say that consumer debt service as a percent of disposable income has been relatively low, mainly because interest rates were low. In fact, if I was to grab my pen here and just show you, if we look at the 2008 period, basically interest rates have been close to zero for almost this whole period of time. So it could be that this shoots up very fast as interest rates continue to rise, because this is consumer debt service, meaning the interest expense that they're paying as a percent of their disposable income. So I would say that counter argument is not super. I think this counter argument actually is very strong. We have a case of consumer debt being risky. Now, another counter argument was consumers need to borrow to tap into their savings. So again, with the personal savings rate falling, excess savings falling, consumers are having to go back to their credit card. So they need to borrow or tap into their savings as disposable income gets eaten up. So consumer savings rates are low. So again, I think that's a pretty strong counter argument. More argument for why Harvey's inverted yield curve signal is working just fine. Well, the consumer is weak as wages aren't keeping up with the fast rise in consumer prices driven by high energy and commodity prices. And the Fed will not reduce its rate rise course soon as unemployment is still low. So what do you think? Well, let's review what we've learned. Cam Harvey is the man behind the most successful recession indicators, and he's saying that it might now give a false signal and we're not going to face recession in 2023. I think I meant to write 23 there. He points out that the U.S. economy is strong and the widespread knowledge of the success of the yield curve could also cause people to adjust ahead of time. Now, many still believe that Harvey's recession indicators will be right for the 9th time since 1968. Higher, for example, falling labor participation, higher consumer debt service, and wages not keeping up. And the question I have for you is, will the 2023 be the first time since 1968 that the inverted yield curve gives a false signal. What do you think? Recession or no recession in 2023? Well, Cam Harvey has weighed in on it, and I've given you some of the counter arguments that I'll discuss in another video.